Society today is composed of a series of institutions. From political institutions, legal institutions, religious institutions, to institutions of social class, familial values, and occupational specialization. It is obvious the profound influence these traditionalized structures have in shaping our understandings and perspectives. Yet, of all the social institutions we are born into, directed by, and conditioned upon, there seems to be no system as taken for granted and misunderstood as the monetary system. Taking on nearly religious proportions, the established monetary institution exists as one of the most unquestioned forms of faith there is. How money is created, the policies by which it is governed, and how it truly affects society are unregistered interests of the great majority of the population. In a world where 1% of the population owns 40% of the planet's wealth, in a world where 34,000 children die every single day from poverty and preventable diseases, and where 50% of the world's population lives on less than $2 a day, one thing is clear: something is very wrong. And whether we are aware of it or not, the lifeblood of all of our established institutions, and thus society itself, is money. Therefore, understanding this institution of monetary policy is critical to understanding why our lives are the way they are. Unfortunately, economics is often viewed with confusion and boredom. Endless streams of financial jargon coupled with intimidating mathematics quickly deters people from attempts at understanding it. However, the fact is, the complexity associated with the financial system is a mere mask, designed to conceal one of the most socially paralyzing structures humanity has ever endured. A number of years ago, the Central Bank of the United States, the Federal Reserve, produced a document entitled Modern Money Mechanics. This publication detailed the institutionalized practice of money creation as utilized by the Federal Reserve and the web of global commercial banks it supports. On the opening page, the document states its objective. The purpose of this booklet is to describe the basic process of money creation in a fractional reserve banking system. It then proceeds to describe this fractional reserve process through various banking terminology, a translation of which goes something like this. The United States government decides it needs some money, so it calls up the Federal Reserve and requests, say, $10 billion. The Fed replies, saying, sure, we'll buy $10 billion in government bonds from you. So the government takes some pieces of paper, paints some official-looking designs on them, and calls them treasury bonds. Then it puts a value on these bonds to the sum of $10 billion and sends them over to the Fed. In turn, the people at the Fed draw up a bunch of impressive pieces of paper themselves, only this time calling them Federal Reserve notes, also designating a value of $10 billion to the Fed. The Fed then takes these notes and trades them for the bonds. Once this exchange is complete, the government then takes the $10 billion in Federal Reserve notes and deposits it into a bank account. And upon this deposit, paper notes officially become legal tender money, adding $10 billion to the U.S. money supply. And there it is. $10 billion in new money has been created. Of course, this example is a generalization, for, in reality, this transaction would occur electronically, with no paper used at all. In fact, only 3% of the U.S. money supply exists in physical currency. The other 97% essentially exists in computers alone. Now, government bonds are, by design, instruments of debt. And when the Fed purchases these bonds, with money it essentially created out of thin air, the government is actually promising to pay back that money to the Fed. In other words, the money was created out of debt. This mind-numbing paradox of how money or value can be created out of debt or a liability will become more clear as we further this exercise. So, the exchange has been made and now $10 billion sits in a commercial bank account. Here's where it gets really interesting. For as based on the fractional reserve practice, that $10 billion deposit instantly becomes part of the bank's reserves, just as all deposits do. And regarding reserve requirements, as stated in Modern Money Mechanics, a bank must maintain legally required reserves equal to a prescribed percentage of its deposits. It then quantifies this by stating, under current regulations, the reserve requirement against most transaction accounts is 10%. This means that with a $10 billion deposit, 10%, or $1 billion, is held as the required reserve, while the other $9 billion is considered an excessive reserve and can be used as the basis for new loans. Now, it is logical to assume that this $9 billion is literally coming out of the existing $10 billion deposit. However, this is actually not the case. What really happens is that the $9 billion is simply created out of thin air on top of the existing $10 billion deposit. This is how the money supply is expanded. As stated in modern money mechanics, of course they, the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes, loan contracts, in exchange for credits, money, to the borrower's transaction accounts. In other words, the $9 billion can be created out of nothing simply because there is a demand for such a loan and that there is a $10 billion deposit to satisfy the reserve requirements. Now, let's assume that somebody walks into this bank and borrows the newly available $9 billion. They will then most likely take that money and deposit it into their own bank account. The process then repeats, for that deposit becomes part of the bank's reserves. 10% is isolated, and in turn 90% of the $9 billion, or $8.1 billion, is now available as newly created money for more loans. And of course, that 8.1 can be loaned out and redeposited, creating an additional 7.2 billion to 6.5 billion to 5.9 billion, etc. This deposit money creation loan cycle can technically go on to infinity. The average mathematical result is that about $90 billion can be created on top of the original $10 billion. In other words, for every deposit that ever occurs in the banking system, about 9 times that amount can be created out of thin air.
Money jitters? Ask the obliging Bank of America for a jar of soothing instant money, M-O-N-E-Y, in the form of a convenient personal loan.
So, now that we understand how money is created by this fractional reserve banking system, a logical yet elusive question might come to mind. What is actually giving this newly created money value? The answer? The money that already exists. The new money essentially steals value from the existing money supply. For the total pool of money is being increased irrespective of demand for goods and services. And as supply and demand finds equilibrium, prices rise, diminishing the purchasing power of each individual dollar. This is generally referred to as inflation, and inflation is essentially a hidden tax on the public.
What is the advice that you generally get? And that is inflate the currency. They don't say debase the currency. They don't say devalue the currency. They don't say cheat the people who are saved. They say lower the interest rates. The real deception is when we distort the value of money. When we create money out of thin air, we have no savings, yet there's so-called capital. So my question boils down to this. How in the world can we expect to solve the problems of inflation, that is, the increase in the supply of money, with more inflation?
Of course, it can't. The fractional reserve system of monetary expansion is inherently inflationary. For the act of expanding the money supply, without there being a proportional expansion of goods and services in the economy, will always debase a currency. In fact, a quick glance at the historical values of the US dollar versus the money supply reflects this point definitively, for the inverse relationship is obvious. $1 in 1913 required $21.60 in 2007 to match value. That is a 96% devaluation since the Federal Reserve came into existence. Now, if this reality of inherent and perpetual inflation seems absurd and economically self-defeating, hold that thought, for absurdity is an understatement in regard to how our financial system really operates. For in our financial system, money is debt, and debt is money. Here is a chart of the U.S. money supply from 1950 to 2006. Here is a chart of the U.S. national debt for the same period. How interesting it is that the trends are virtually the same. For the more money there is, the more debt there is. The more debt there is, the more money there is. To put it a different way, every single dollar in your wallet is owed to somebody by somebody. For remember, the only way the money can come into existence is from loans. Therefore, if everyone in the country were able to pay off all debts, including the government, there would not be $1 in circulation. In fact, the last time in American history the national debt was completely paid off was in 1835, after President Andrew Jackson shut down the central bank that preceded the Federal Reserve. In fact, Jackson's entire political platform essentially revolved around his commitment to shut down the central bank, stating at one point, "The bold efforts the present bank has made to control the government are but premonitions of the fate that awaits the American people should they be deluded into a perpetuation of this institution or the establishment of another like it." Unfortunately, his message was short-lived, and the international bankers succeeded to install another central bank in 1913, the Federal Reserve. And as long as this institution exists, perpetual debt is guaranteed. Now, so far we have discussed the reality that money is created out of debt, through loans. These loans are based on a bank's reserves, and reserves are derived from deposits. And through this fractional reserve system, any one deposit can create 9 times its original value. in turn debasing the existing money supply, raising prices in society. And since all this money is created out of debt and circulated randomly through commerce, people become detached from their original debt, and a disequilibrium exists where people are forced to compete for labor in order to pull enough money out of the money supply to cover their costs of living. As dysfunctional and backwards as all of this might seem, there is still one thing we have omitted from this equation. And it is this element of the structure which reveals the truly fraudulent nature of the system itself: the application of interest. When the government borrows money from the Fed, or when a person borrows money from a bank, it almost always has to be paid back with accrued interest. In other words, almost every single dollar that exists must be eventually returned to a bank with interest paid as well. But if all money is borrowed from the central bank and is expanded by commercial banks through loans, only what would be referred to as the principal is being created in the money supply. So then, where is the money to cover all of the interest that is charged? Nowhere. It doesn't exist. The ramifications of this are staggering, for the amount of money owed back to the banks will always exceed the amount of money that is available in circulation. This is why inflation is a constant in the economy, for new money is always needed to help cover the perpetual deficit built into the system, caused by the need to pay the interest. What this also means is that mathematically, defaults and bankruptcy are literally built into the system, and there will always be poor pockets of society that get the short end of the stick. An analogy would be a game of musical chairs, for once the music stops, somebody is left out to dry. And that's the point. It invariably transfers true wealth from the individual to the banks. For if you are unable to pay for your mortgage, they will take your property. This is particularly enraging when you realize that not only is such a default inevitable due to the fractional reserve practice, but also because of the fact that the money that the bank loaned to you didn't even legally exist in the first place. In 1969, there was a Minnesota court case involving a man named Jerome Daly, who was challenging the foreclosure of his home by the bank which provided the loan to purchase it. His argument was that the mortgage contract required both parties, being he and the bank, each put up a legitimate form of property for the exchange. In legal language, this is called consideration. Mr. Daly explained that the money was, in fact, not the property of the bank, for it was created out of nothing as soon as the loan agreement was signed. Remember what modern money mechanics stated about loans? What they do when they make loans is to accept promissory notes in exchange for credits. Reserves are unchanged by the loan transactions, but deposit credits constitute new additions to the total deposits of the banking system. In other words, the money doesn't come out of their existing assets. The bank is simply inventing it, putting up nothing of its own, except for a theoretical liability on paper. As the court case progressed, the bank's president, Mr. Morgan, took the stand, and in the judge's personal memorandum, he recalled that the plaintiff, bank's president, admitted that, in combination with the Federal Reserve Bank, did create the money and credit upon its books by bookkeeping entry. The money and credit first came into existence when they created it. Mr. Morgan admitted that no United States law or statute existed which gave him the right to do this. A lawful consideration must exist and be tendered to support the note. The jury found that there was no lawful consideration, and I agree. He also poetically added, only God can create something of value out of nothing. And upon this revelation, the court rejected the bank's claim for foreclosure, and Daly kept his home. The implications of this court decision are immense. For every time you borrow money from a bank, whether it is a mortgage loan or a credit card charge, the money given to you is not only counterfeit, it is an illegitimate form of consideration, and hence voids the contract to repay, for the bank never had the money as property to begin with. Unfortunately, such legal realizations are suppressed and ignored, and the game of perpetual wealth transfer and perpetual debt continues. And this brings us to the ultimate question: why? During the American Civil War, President Lincoln bypassed the high-interest loans offered by the European banks and decided to do what the Founding Fathers advocated, which was to create an independent and inherently debt-free currency. It was called the greenback. Shortly after this measure was taken, an internal document circulated between private British and American banking interests stated, "Slavery is but the owning of labor and carries with it the care of laborers, while the European plan is that capital shall control labor by controlling wages. This can be done by controlling the money. It will not do to allow the greenback, as we cannot control that." The fractional reserve policy perpetrated by the Federal Reserve, which has spread in practice to the great majority of banks in the world, is, in fact, a system of modern slavery. Think about it. Money is created out of debt. And what do people do when they are in debt? they submit to employment to pay it off. But if money can only be created out of loans, how can society ever be debt-free? It can't, and that's the point. And it is the fear of losing assets coupled with the struggle to keep up with the perpetual debt and inflation inherent in the system, compounded by the inescapable scarcity within the money supply itself, created by the interest that can never be repaid, that keeps the wage slave in line, running on the hamster wheel with millions of others, in effect powering an empire that truly benefits only the elite at the top of the pyramid. For, at the end of the day, who are you really working for? The banks. Money is created in a bank and invariably ends up in a bank. They are the true masters, along with the corporations and governments they support. Physical slavery requires people to be housed and fed. Economic slavery requires people to feed and house themselves. It is one of the most ingenious scams for social manipulation ever created, and at its core, it is an invisible war against the population. Debt is the weapon used to conquer and enslave societies, and interest is its prime ammunition. And as the majority walks around oblivious to this reality, the banks, in collusion with governments and corporations, continue to perfect and expand their tactics of economic warfare, spawning new bases, such as the World Bank and International Monetary Fund.
Done. I want out.
It's just money. 1637, 1797, 1819, 37, 1901, 29, 1937, 1974, 1987. Jesus, didn't that fuck me up good? 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
The law of gravity hit Wall Street today and financial markets around the world for that matter.
The inflation rate is worsening.
We're going to see one of the biggest recession and financial crashes of all time.
The internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash, a method whereby on the internet you can transfer funds from A to B without A knowing B or B knowing A.
Bitcoin, a peer-to-peer electronic cash system by Satoshi Nakamoto. Abstract, a purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution.
I sent 100 euros worth of Bitcoin from here in Tokyo directly to you guys through this camera, through the network, through the TV, right into your home. If I had tried to do that, send you the money with a traditional bank, it would have taken several days and probably cost 30 euros. I just did it right now with Bitcoin instantly, basically for free, and didn't have to ask anybody for permission. I didn't need a bank, I didn't need a government, I didn't need anybody. I just needed myself and you and our smartphones to do it. That's the power of Bitcoin.
Worldwide this morning, growing concern over a growing health crisis, with health officials here in the U.S. moving fast to prepare for what the CDC has called an inevitable spread.
We are right now in a very active containment mode.
Thousands of Americans nationwide already under voluntary self-quarantine after returning from China, even though they don't pose any immediate risk.
Central banks around the world have injected money into the economy at a record pace to try to fight a global recession triggered by the coronavirus pandemic.
Just getting word from the Federal Reserve.
Bombshell announcement from the Federal Reserve.
It is an absolutely historic week, both in terms of the speed of Fed purchases and, of course, the magnitude.
Since mid-March, the Federal Reserve's balance sheet has ballooned from $4 trillion to around $7 trillion, equal to about 1/3 of the value of the entire American economy.
A new CNBC survey showing that market participants expecting trillions more in stimulus from both the central bank and Congress.
At the same time, governments have enacted record amounts of fiscal stimulus to boost economies stalled by the pandemic. The infusion of cash into the financial system has renewed concerns that inflation could surge.
As Milton Friedman said, inflation is always and everywhere a monetary phenomenon. If you believe that, you look at the central bank balance sheets exploding right now, and you say, there's going to be inflation.
No, I'm in the camp that it's transitory. The best example that we've been giving to people is pretty much like when you see a new blockbuster video coming out for the first time, let's say Star Wars, and that night, opening night, everybody's standing in line and they're paying a premium price to go see the movie. A couple of weeks later, there's no lines, and you can see it anytime you want, at any place you want to. And then a year later, you stream it for $3.99 to your home. And I think that that's exactly what's happening. You have all consumers simultaneously coming out of spending hibernation, spending on the same things. And I think the best example I can give you right now is travel. I mean, if you want to travel this summer, you're going to pay a premium price, whether that's hotels or airfare. But I think once we get to September, when children are back in-person schooling, I think that's when you see prices start to come down. So I just think this is a digestive period as we're all looking and spending on the same things.
All right, let's talk about Chair Powell a little bit, Lindsay, and what you might expect him to say tomorrow. My impression is that you would expect him to be resolute in saying that this inflation little spikelet that we're seeing is transitory, number one. Number two, you would expect him to be resolute in saying that he is going to continue the stimulus as is for the time being, or for the foreseeable future, or for whatever time period he suggests. Let me ask you whether you agree with that and whether you think that the continued stimulus is called for, given the way the economy is performing.
Well, there's two parts. First off, I do think that the chairman will reassert their assessment that inflation is transitory, and they'll be pointing to some of the categories that we saw in consumer prices, some that are less impacted by the virus, so rents, medical care services. These prices were slowing their ascent, so already we're starting to see evidence of exactly what the Fed predicted in terms of inflation continuing to rise, but again, expecting that to slow its ascent going into the end of the year.
The boss appears to be laying down the law. Fed Chief Jerome Powell has ordered staff to review the central bank's ethics rules after several Fed presidents revealed large investments in stock trades. Yahoo Finance Fed correspondent Brian Chung is here with the details. Brian.
Well, Brian, anytime the Federal Reserve's code of ethics is in the news, it's probably not a good thing. And all this swirling around the disclosure that we got from the Dallas and the Boston Fed presidents just a few weeks ago, detailing several multi-million-dollar transactions. You'll recall that Robert Kaplan, the head of the Dallas Fed, made investments over the course of 2020 in stocks like Delta, Chevron, Verizon, which is Yahoo's former parent company, Apple, including also a floating bond rate ETF. And all of that followed from another report from Bloomberg that said Boston Fed President Eric Rosengren made several large transactions in real estate investment trusts. Now we're getting a follow-up from the Federal Reserve Board. Keep in mind the Federal Reserve Board sits on top in terms of the Federal Reserve system structure over the 12 reserve banks across the country. And Fed Chairman Jerome Powell now saying that he wants to review the ethics rules across the system. This is a statement from a Fed spokesperson that I want to read to you, which I believe we have a full screen of. Quote, "Because the trust of the American people is essential for the Federal Reserve to effectively carry out our important mission," Chair Powell late last week directed board staff to take a fresh and comprehensive look at the ethics rules around permissible financial holdings and activities by senior Fed officials. And the fallout is continuing. There was actually the Revolving Door Project, which is a DC-based advocacy group, this morning calling for Powell to put both of the bank presidents on leave. It's unclear about whether or not he has the authority to do that, but it seems like headed into the Federal Reserve's next policy setting meeting next Wednesday, the Fed does appear to be embroiled in what some sources have told me is a scandal, which is never a word you want to hear within the context of the independent central bank, guys.
And not one you normally hear in the context of the independent central bank, Brian. But just to be clear, the two Fed presidents, they didn't break any laws, right?
They didn't break any laws, and for what it's worth, the disclosure that we got from both of those Fed presidents clarifies that they felt that those transactions were within the code of ethics.
Scott, the Federal Reserve at this time announcing sweeping new rules to bar Federal Reserve officials from purchasing individual securities. This will apply to Fed officials, policymakers, and senior staff. It will prohibit the purchase of individual stocks and bonds, agency securities, or agency mortgage-backed securities, or entering into options, futures, and other derivative transactions. All of this comes in response to questions of conflicts of interest raised by large-scale individual transactions by Fed Presidents Robert Kaplan and Eric Rosengren, both of whom have since resigned. And it comes with some Fed officials, including the Fed chair, holding assets previously purchased that the Fed ended up buying in the year 2020 in response to the pandemic. The new rules, investors will be limited to mutual funds or similar what they call collective investment vehicles. Officials will have to obtain prior approval for purchases and sales of securities up to 45 days ahead of time and hold investments for at least 1 year. No purchases or sales will be allowed during periods of what they call heightened financial market stress. Reserve Bank presidents now will be required to publicly disclose financial transactions within 30 days, as board members and senior staff currently do.
Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support.
Wall Street's top investors are bracing for the biggest stock market crash of our lifetime, with the tech bubble burst leading the meltdown that will start over the next few weeks. The stage is set for an epic financial disaster, and after the explosion, we will be headed to the worst economic depression we've ever faced in the history of the United States. That's what one of the most successful investors and market strategists of modern times is telling us.
We are seeing the crypto markets crash completely. We have Bitcoin below 30,000. We have UST going all the way to about 29 cents. We have Terra Luna losing almost 100% of its value in the last days. So
New crypto laws are coming. I'm currently looking at a 69-page document that outlines regulations for just about everything having to do with crypto, from stable coins, illegal securities, taxes, even crypto retirement accounts. You're probably going to like some parts of this, other parts, not so much.
All right, so Coinbase is currently facing a number of issues and lawsuits with the U.S. government. The SEC is currently investigating Coinbase on suspicion they have been allowing their U.S. customers to trade unregulated securities because the SEC is alleging that 7 different cryptocurrencies listed on Coinbase's platform were actually securities.
Crypto companies called on celebrities to help sell the fortune of the future.
Fortune favors the brave.
But if you listen to Matt Damon and invested, say, $1,000 that day the ad came out last October, you'd have about $360 left today, losing almost 2/3 of your money. The ongoing crypto crash mirrors how stocks are cratering too, but more sharply as the Fed raises interest rates to battle soaring inflation.
What is happening with the crypto market right now?
The broad picture right now is that you have the Federal Reserve hiking interest rates today, and there is a big fear at the moment as to what that means for markets of all stripes, and crypto is definitely one of them.
Do you remember the moment when crypto started making sense to you? For me, it was when I realized that there was much more to cryptocurrency than just Bitcoin. There are thousands of other coins, tokens, and decentralized applications with their own unique use cases and characteristics. Now, I remember that when I first tried telling my friends and family about this enormous ecosystem, it flew right over their heads. And that's part of why I decided to start this channel. Education is the key to the mass adoption of cryptocurrency, but the start of that crypto learning curve can be steep for the fiat sheep. Concepts like blockchain, mining, and staking are hard to understand and even harder to explain in simple terms, as I'm sure many of you can attest. This can be a problem when you're trying to help your friends, family, and significant other understand where all your money is going and why.
Banks are one of the engines of the modern economy, but the way they work is under threat. Tech payment giants and digital currencies are revolutionizing how people use money. And this could have dramatic consequences far beyond banking. It could affect consumer privacy, government power, and the stability of the entire financial system.
It is difficult to overstate sort of how radically different that world could be from the one that we live in now.
So what would a world without banks look like? And would you even miss them?
Very cool. It sounds like central banks are done. What will be.
We'll see what happens. I think, again, it comes down to technology, right? So right now, we're in the process of testing this 13-year-old technology.
Yeah.
Right? So in the beginning, the funny thing is when you look at the forums, when WikiLeaks turned to, using Bitcoin, Satoshi got nervous.
Yeah, of course.
He wasn't sure it was ready for that.
Yeah.
And of course, we've come a long way since then. But it always requires a degree of humility to see, is this network ready for this? Can it withstand a certain state attack? Can it withstand, this happening, right? So everything that Bitcoin goes through, we're testing to see how hard and how durable the network is. So the Mt. Gox attack, certain countries banning it, unbanning it, China banning Bitcoin miners. What happens in this environment? What happens in this environment? What happens if 1 million altcoins try to scam people into going into other systems and then they blow up and they have to sell their Bitcoin into the weak market? So we're testing every step along the way. Is this the right system? What are the attack vectors? Is there some sort of way to exploit it? Can we hack it? Things like that, right? We're kind of testing all this through. And so looking super far ahead can be premature because we're still testing the system, but we have a clear direction here. The Pandora's box has been opened in terms of cryptographic money, peer-to-peer money, self-custodial, using encryption, and we see a clear direction. And then the question just becomes, does any risk that we haven't accounted for throw us off of that? And if no, then we, basically it becomes continually a stronger form of money than anything we've had before. And then it becomes a question of what does that mean? What does that mean for central banking? Does it arbitrage between the economy moving faster than the money go away? And does it mean that, we have, say, created some sort of asymmetrical technology that empowers people over larger entities? Because, again, in the prior conversation, we talked about the Oslo Freedom Forum and Human Rights Foundation. This is a strong environment for authoritarian regimes because if you control the banking system and if you have advanced surveillance technology and, big data, you have a lot of top-down power. And whereas cryptographic money is kind of bottom-up power. And the question becomes, which one of those two forces is stronger?
Yeah, I'm all for any form of money that anybody wants to use. And ideally, I'd like to get government out of the money business, just like we used to have church and state were once together. We wouldn't be able to have this meeting without officials from the church hundreds of years ago. And we should get government out of the money business. We can separate money just like we separated church and state. We can separate money and state. Because government doesn't need to be in the money business. We don't need politicians to tell us what money is. Throughout human history, for thousands of years, people have figured it out, whether it's gold or silver or Bitcoin. And the fact is that our money right now is broken. Politicians broke it. They have unlimited money that they can print from thin air without accountability. And that is now competing against an asset like Bitcoin, which is limited in supply, limited to 21 million coins, cannot be printed from thin air. So the money is broken, and politicians broke it, and everybody should have the freedom to choose better money if they choose to. I chose Bitcoin. I recommend other people choose something else as well because the dollar is a melting ice cube.
This experiment that you're all running, I'm running, all the people who are involved in the cryptocurrency world are running, is like, well, okay, we're going to take money out of the hands of politicians. Because it's not just politicians, that's you guys too. We have no idea what would happen if money per se was actually decentralized. And we also don't know, like if we manage that, let's say Bitcoin attains primacy, is it irreversible? Like, is that permanent? And then you think, well, what if it's a bad idea and it's irreversible? I'm not saying it is, and I'm not even saying I'm necessarily pessimistic about it, but the probability that you invent something extremely powerful and it only does the things you think it will do and all those things are good, it's like, no, that never happens.
The ego is the worst confidence trickster we could ever figure, we could ever imagine, because you don't see it.
And the single biggest con is, I am you.
The problem is that the ego hides in the last place, if you'd ever look, within itself.
It disguises its thoughts as your thoughts, its feelings as your feelings. You think it's you.
People's need to protect their own egos knows no bounds. They will lie, cheat, steal, kill, do whatever it takes to maintain what we call ego barriers.
People have no clue that they're in prison. They don't know that there is an ego. They don't know the distinction.
At first, it's difficult for the mind to accept that there's something beyond itself, that there's something of greater value and greater capacity for discerning truth than itself.
In religion, the ego manifests as the devil. And of course, no one realizes how smart the ego is because it created the devil so you could blame someone else.
In creating this imaginary external enemy, we usually made a real enemy for ourselves. And that becomes a real danger to the ego, but that's also the ego's creation.
There is no such thing as an external enemy, no matter what that voice in your head is telling you. All perception of an enemy is a projection of the ego as the enemy.
In that sense, you could say that 100% of our external enemies are of our own creation.
Your greatest enemy is your own inner perception, is your own ignorance, is your own